IFRS 16 was passed in January of 2016 by the International Accounting Standards Board, and it's the International Financial Reporting Standard that covers the subject of leases. It has to do with the recognition and measurement of leases, for example, the measurement of lease liabilities and disclosures related to leases for both lessors and lessees. But the biggest changes of IFRS 16, based on its previous standard for leases, which was International Accounting Standard 17, the biggest change that IFRS 16 brought was for lessees, and it requires the capitalization of all leases. There are only two exceptions. One is for short-term leases, 12 months or less. Another is for leases of low-value assets, $5,000 or less. I'll cover those in videos to come. But all other leases, the lessee has to capitalize the lease. What does that mean? Even though they are not buying the leased asset, let's say it's a truck, okay? The lessee, they're leasing a truck. Even though they are not purchasing the truck, they're just renting it, okay? They are going to have to recognize that truck as a right-of-use asset on their statement of financial position, their balance sheet, and the lease payments, the present value of the lease payments, they're going to have to recognize as a lease liability. Okay, so we're going to have assets and liabilities related to this lease on the lessee's statement of financial position, even though they have not bought the asset that they are leasing. Okay, so capitalization of all leases. Now, why did the IASB create IFRS 16? What's going on here? Well, they wanted to increase transparency in financial reporting with respect to lessees. Long story short, what happened was under the old rules, lessees were using leases to keep debt off of their balance sheet, off of their statement of financial position. So if you've ever heard of off-balance sheet financing, one means of doing that was, let's say you were a company, so you are an airline. Okay, so you're an airline and you'd get these airplanes. Instead of buying the airplanes, you would lease them, and companies would structure the leases in such a way that all the payments they were going to have to make for those airplanes, it might be a 20 or 30-year lease or something like that, all those payments, they were not appearing as a liability on the lessee's statement of financial position. So these are long-term obligations in some cases. Like I said, it could be 20 or 30 years of lease payments. And so you have these airplanes, and for all intents and purposes, I mean, this is a major part of your business, but it is not appearing anywhere on your statement of financial position, aka your balance sheet. That's what they call it, off-balance sheet financing. They were keeping the debt off of the balance sheet. And so IFRS 16 was intended to address that and say, okay, all leases need to be capitalized. They're going to be on the statement of financial position with those two exceptions that I talked about, just for short-term leases and leases of low-value assets. All other leases, the lessee is going to have a right-of-use asset and a lease liability. So what are the effects for lessees in terms of their financial reporting? Well, I already mentioned there's going to be more assets and more liabilities, because before you had some leases where they did not have to recognize the right-of-use asset or the lease liability, but now they do. All leases except for those two exceptions. They are going to have to recognize an asset and a liability. So what does that mean? You could have a company that has a lot of leases, and once the standard became effective and they started having to follow IFRS 16, their total assets are going to go up and their total liabilities are going to go up, because there were leases that they previously had not been having the asset or liability appear on their statement of financial position, and now that will be the case. So you're going to have higher assets, higher liabilities, because some of the leases that were previously not capitalized because of IFRS 16, now companies are having to capitalize those leased assets. Front loading of expenses, and we will talk about this more in the future videos, but let me just give you an idea. So in the past, okay, prior to IFRS 16, you could have a lease structured in such a way that, I'm just going to make up some numbers here. Let's just say that there was $5 million of lease expense. Okay, $5 million of lease expense every year. So it was just $5 million, $5 million, $5 million for something that they were leasing. Let's say they were leasing an airplane or whatever. Okay, so the lessee, I'm talking about here, the lessee, the one that is renting they're the airline saying, hey, we're going to rent this airplane. Okay, so $5 million. Okay, every period, that's what their lease expense was. But when you capitalize that lease, okay, which is required of all leases under IFRS 16. So when you capitalize that lease, you're not just going to have lease expense now if you're the lessee. You're not just going to say, oh, $5 million of lease expense. Now you're going to recognize two expenses. Depreciation expense, okay, that has to do with the right-of-use asset. Remember I said now they have to recognize the right-of-use asset. So depreciation of the asset, But then the interest expense related to the lease liability. Okay, so if you add this and add this, you could think of that as the total lease expense, is the depreciation expense and interest expense. But these are separately laid out. Okay, you got the depreciation expense and the interest expense. Now, why does that lead to front load? In front loading, what I'm talking about, let me just give you an example. So let's say you have 7 million, 6 million, and then 5 million or something like that, or you had 6 million, 5 million, 4 million, whatever. I'm just like, you have more in the early years of when you're renting this asset, you have more total expense when we add up the depreciation and interest expense. So basically total lease expense is higher in the early years of the lease. Why is that the case? Because, okay, let's just say they're using straight line depreciation to depreciate the assets. So then we'll forget about, the depreciation is just even. But the interest, so I will show you how we calculate the lease liabilities, the present value, the expected lease payments. Basically, the lease liability, we're going to use something called the effective interest method, and I'm going to show you all this stuff in detail, so don't worry. But long story short, the lease liability is largest in the earliest periods of the lease. And the interest expense is calculated by taking the discount rate, which I'll show you how to figure that out. Take the discount rate and multiply it by the lease liability. So because the lease liability is the largest in the early years of the lease, you're multiplying a larger number times the discount rate. And as the lease liability goes down, and you say, why would the lease liability go down? Because they're making payments. The lessee is making payments. And so every time they make payment, that reduces the lease liability. They don't owe as much, right? They've made payments. So as they make payments, the lease liability goes down and the amount of interest expense goes down. So that's why we have more. So this was talking about the front loading expenses, okay, because of the capitalization of the lease. Now, another effect for lessees, okay, is higher earnings before interest, taxes, depreciation, and amortization, EBITDA, okay, higher EBITDA. Why is that the case? Because under the old accounting rules, okay, remember I said it was just lease expense each period? So lease expense reduced EBITDA, okay? So if a company had more lease expense, if lease expense increased, okay, that would reduce its EBITDA. Under the new rules, a lessee is not recognizing lease expense anymore, right? Now they're recognizing depreciation expense and interest expense. You could think about these conceptually as this plus this is total lease expense, but it's actually labeled depreciation expense of the right-of-use asset and interest expense on the lease liability. And notice, depreciation expense and interest expense, they do not reduce EBITDA. Why? Because it's earnings before interest, taxes, depreciation, and amortization. So interest expense, no matter how high it is, it doesn't affect EBITDA. Depreciation expense, which is the D here, no matter how high it is, that does not affect EBITDA. So basically, when IFRS became effective, then you have lessees were actually reporting higher EBITDA than they had under the old rules. So these are some of the financial statement effects for lessees. In the videos to come, we will talk about the specific accounting for lessees and lessors under IFRS 16.